Great to see you in class today. I hope you enjoyed the lecture. It was a good class, and I think we covered a lot of good ground on doing evaluation using the discounted cash flow. As promised, I said I would do also a dividend valuation model and also take a look at multiples. When we do more valuations in the future, as we do the case and as we do the um, private company valuation, probably review some of these things as well in class, but I want to make sure I go through some of the points in the PowerPoint slides. This is the stuff that's going to be in the midterm and in the finals, so I want to make sure that I cover it adequately. But in terms of its relative importance, discounted cash flow is the foundation to all valuation, so it's critical that you understand that. So as you can see on the screen here, we've got the dividend growth model that we're going to look at. And this is for companies that are generally paying a dividend. They pay dividends based on the stability of their earnings or the size of their company. And sometimes the investors just care only about what they're receiving from the company in terms of a return, and that's how they're going to value it. So, it's another method. And so this is the way you do it. I list the steps out, and I have the assumptions on the next slide. You just calculate the required rate of return. You find the dividend in year one, or we call it D1, and then apply the dividend model, which you see below there. Okay, so first calculate the required rate of return. And if I'm on an exam, I'd tell you what these things are. You would also be able to figure this out by going to the data sources. You look at the beta for the company. We know what the risk-free rate in the market is generally 5%, even though I had 7% here. And then the market premium is usually between 5 and 8%, depending on what the S&P is doing. Okay, so if we're going to use the CAPM, or the security market line, to figure out the rate of return, we just plug those numbers into our formula. 7% plus 5% times 1.2, which is equal to 13%. So that's the required rate of return on this company. So once we've found that, then that's the first thing. So you can see in my blue box, the required rate of return is 13%. Now we're going to do steps 2 and step 3. Find the dividend in year one, and then apply the model here, as you can see in step 3. And as we do that, you can see that the dividend in year one is simply, if it's a $2 dividend and it's got a growth of 6%, that means dividend in year one is expected to be $2.12. Then we put that into the model, the $2.12, and divide that by the required return, which is 13%, minus the 6% from the growth, and that gives us a stock price of $30.29. So if you're looking at my spreadsheet, you can just put that into your model. You can see it's very straightforward. You just need to combine the rate of return, the dividend expected growth, and then just divide the dividend in the next year divided by that minus the growth rate. So, and that gives us a price of $30.29. Okay. Pretty straightforward, but again, it's only for companies that have stable earnings or have declared dividends over a long period of time. And, you would require a stock price of $30.29 based on the growth rate that you put in there. Now, of course, if you put a different growth rate and you have a different view of how the market's going to grow, and if you don't agree with the required rate of return, you could come up with a different formula or different numbers than what's there, and that's what would cause you to believe that the stock is either over or undervalued. Okay, let's look at multiples now. And so we look at the PE multiple, which is the price per share divided by the earnings per share. So The price is the stock price, and then the earnings per share is divided by the earnings divided by the per share value. Okay, and so estimate the PE ratio of comparable firms, and I'll multiply this average PE by the expected earnings of the company to estimate the stock price. So that's how you use a PE. So you look at the expected earnings, you look at the ratio. If the ratio is 5 and the earnings are 50, then it's going to be 5 times 50. So so I look at some multiples of certain stocks in February of 2022. If you look back, this was before the market went crazy on Nvidia, but you can still see that people had a belief about Nvidia that was causing their price earnings to be much higher, especially than Intel. In fact, people believed that Nvidia stock was 10 times the value of Intel, which is kind of interesting. And then, of course, you have an average of 31 in February of 2022. Then a year later, in February of 23, this is right after ChatGPT became known to the world. And they realized that NVIDIA was the only company that could power AI. The stock went up. But not all the stocks went up. And companies that were not looked at as having a strong ability to deliver on AI were then discounted. And you can see like Ace Technologies is really gone down. And it probably reflects that a lot of investors pulled their money out of Ace and put it into NVIDIA and drove up their stock price. Intel got a little bit of a boost. You can see a number of that have gone down. In fact, the average PE for these 9 companies is 31.19 and 22, and a year later it's 23.60, with most of them retreating a little bit. Okay, and then March 24, this was a year ago actually today, and you can see that Intel really skyrocketed. And then some of these others came back, but most interestingly enough, NVIDIA came down. And what you have now is an average that is better than 23, but still less than February 22. So what that tells you is that there's a lot of belief that in February of 22 of what these chips are worth, these chip companies are worth. And so it might be a little bit of hype and anticipation causing these to increase. And then when the news comes out, we see in February 23 who the winner is. But when the dust settles, we see that it comes down even more. And if I remember correctly, I think I did some analysis on this on just today. I'm trying to find it. And I'll share that in just a second. See if it comes up. Okay, so as you look at this spreadsheet, this is as of today. We did July 2024 in there, and you can see the average PE was 29.41. And as of today, this same group right here, the average was 26.85, which is almost, it's getting closer to the February 23 numbers. But the big difference, of course, is NVIDIA, which has really come down over the years. So as fun as that stock has been to watch, and it also, the share prices, are their price earnings ratio has become less expensive, even though the share price might have gone up because the earnings have gone up to match it. So anyway, so it's interesting just to see how to compare these companies one against the other. And so if we were to then look at NVIDIA's earnings, we would take their earnings and then multiply it by 52.09, and that would tell us what the value of the company is. And then we can just basically look and say, okay, it looks like Intel, which had negative earnings, might be the cheapest stock on the list, but you better beware buying it. And then we can look at share prices. I did do the share prices, um, and this is, I think, after the stock split. I have to check a look at that again because it did a 10-for-1, just a few like last year. So anyway, but the real thing to do is compare multiples, and it looks like our friend NVIDIA is coming down. Okay, and so that's the purpose of multiples. It's sort of the first step when you're sitting around talking about companies. You say, well, how expensive is it? And the data point that you use is the multiple of the company, which is the price divided by the earnings per share, which creates the earnings per share. Okay, so I do a little bit of analysis on here. And there are a lot of different entity multiples that you can use. It's just not price earnings. Every industry is different, and every industry will pick a different measure that is important to their firm. And so don't get stuck on just the PE, although the PE is the sort of the first starting place. But when you start maybe talking about real estate or high tech, you have a very different conversation using multiples. Okay, and so and then you can do the same thing. You subtract, you find the entity value, and you times it by the multiple, and then you subtract the debt, subtract the preferred, add the short-term investments, and then divide by the number of shares to get the price per share. So it's the same thing that you would do with the others to get the final stock price using multiples. Now, here are the problems with market multiples, especially when you talk to CEOs. They'll always tell you it's hard to find comparable firms. No one's like them. They're all different. And in some cases, they're correct. I mean, how many companies do you have like Facebook? And how many companies do you have like Google? Not very many, but then they're all sort of put in the same basket because you're comparing social media companies, even though they probably claim they're a little bit different from each other. Okay. And then the other problem with multiples is the average ratio for the sample of comparable firms often has a wide range, as we saw in the chip sector. That's the share price. Let me go back here. You can see that the multiples go anywhere from 9 in February of 22, 987 all the way to 89. That's a big range. And so it makes it a little bit tricky. Okay, and so let's see. So we got the problem with that, and then we got preferred. We've talked a little bit about that, but it's a hybrid. I think we've talked about this in class. It's similar to bonds, it's similar to stock, it's right in the middle. That's why they call it a hybrid security. And it's very popular in Utah with technology startup companies because it allows an investor to either make their, they write terms when they invest in a company, and they say, maybe I'll invest, when I buy your equity, I'll make it a preferred share so that I can convert it to a bond if the company is not doing well, or I can convert it to a common if the company is doing well, just whatever way I can get the best return out of the company. And then if you want to do the value of a preferred, it's very similar to the dividend. You take a dividend in year 1, divided by the rate of return, and you get a share price of around 30. Okay, there are other items in the appendix if you want to take a look at that, but none of that will be on the exam. If you do want to go through it, please let me know, and I'd be happy to have that conversation with you. Okay, good class today. I hope you enjoyed it, and we'll be talking about this more in the future, but just wanted to make sure that we covered the rest of the chapter. And if you have any questions, as always, please let me know. Thanks. We'll talk to you next week. Or no, we'll talk to you in 2 weeks when we get back from spring break.